Welcome to the FedLife podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello and welcome to this episode of the FedLife podcast. No surprise, I'm back. I'm your host, Dan Sipe. Additionally, as you already have heard 1,000 times, I am the branch manager here at Serving Those Who Serve and Lee Sipe and Associates. Going to start as I always do. Thank you for taking the time to listen, and thank you for your service. To me, to everybody else in the country, you don't hear it enough, you'll always hear it here. You are the folks that hold everything together, make everything happen, and we are grateful for that. The Fed's best friend, Ed Zurndorfer, is back with us today. The guru is here as part of our ongoing mission to reach, teach, and serve you. And at the outset, as I have to do every time, I have to say the opinions of Ed Zurndorfer are not the opinions of Raymond James of Serving Those Who Serve. This podcast is presented for information only. It is not intended to be taken as advice, and all listeners should consult their personal advisors before taking any action. And if you don't have one, hit us up at Serving Those Who Serve. We'll help you the best we can. As you know, we follow Ed's FedZone articles, and that gives us more than one way to reach, teach, and serve you. So in this episode, we're wrapping up on the tax tips front. We thought we already did that. We thought we were going to be done because I know I'm not supposed to break the fourth wall and say what date this is, but this is actually April 15th. And that is usually the date that Ed is set free for a little bit from his tax practice. But Uncle Sam extended the filing date this year. So Ed, for the second year in a row, we are extended, but not as much as last year. So tell us what's up.
This year, Dan, yes, we are extended, but only till May 17th, not to July 15th as it was in 2020. So the filing deadline is May 17th, but that comes with a few caveats, though, which we need to talk about, because the filing deadline is, as I said, it is extended until May 17th, which means that if you owe money on your 2020 federal income taxes, you have until May 17th to pay. That extension only is to file your taxes, but not if you have any balance due to go beyond that. You have to pay by May 17th. If you feel you cannot finish your taxes in time by May 17th, yes, you can request for an extension until October 15th, but if you owe anything, you must pay that with your extension, whatever you think you're going to owe. Otherwise, there's going to be a nasty penalty if you have to pay anything beyond May. If you have any balance due May 17th and you pay it, you don't file for pay it with the extension.
Gotcha. Not everything got extended, correct? So our feds who might be making quarterly tax payments, they still have the April 15th date today.
Dan, there's been so much confusion on this, and I hope we get it all straightened out today, because today is a very important deadline. Anybody who pays quarterly estimated taxes, that means they pay roughly every 4 months their amount of taxes that they owe for that quarter. The deadline for the first quarter of 2021 is today, April 15th. In other words, the filing deadline of May 17th only applies for filing your 2020 income taxes. If you owe any taxes for 2021 in the form of quarterly estimated taxes, the first payment, the first quarter deadline is April 15th. It always is, and that was not extended. So if you are due to pay any quarterly estimated taxes for the first quarter, you got to get them in the mail today, or you can do it online if you have an account. But it has to be postmarked today, April 15th. That was not extended.
Gotcha.
What was extended, though, as part of the filing deadline is that if you would like to make a 2020 IRA contribution, it can be any type of IRA, traditional or Roth, that deadline was also extended to May 17th.
Got it.
But this is, I want to emphasize, Dan, this is only the federal.
Yeah, the states are making their own decisions.
And that's absolutely correct. For example, Dan, the state of Maryland has extended its filing deadline to July 15th. July 15th.
Gotcha.
But also, and this is where the confusion is, we were just talking about the quarterly estimated taxes for the federal that are due for today, April 15th, for the first quarter. Maryland extended not only the first quarter estimated tax payment for 2021, which is normally due today, but the second quarterly estimated tax payment, which is due June 15th. Both the first and second quarterly estimated taxes for Maryland were extended to July 15, 2021. And this is where the confusion is. I mean, I've gotten emails from clients. Oh, so and so told me that I can file my quarterly estimated taxes for IRS. I have until May 17th or July 15th. No. There's a difference. The states make their own decisions. So please make sure that if you owe any quarterly estimated taxes, that you double check. If you do your own taxes, go to the respective website, to your state website. If someone else prepares your taxes, talk to your tax professional to make sure that you know what the deadlines are for filing your quarterly estimated taxes.
That makes sense. And the other thing, Ed, obviously this is a podcast and not a radio program. Somebody may be listening to this, obviously, after today. Relative to those quarterly payments, they can still make it. It's not the end of the world. They will pay a little bit of interest on that, correct?
Yes, Stan. And many times I get this question. Somebody says to me, "Oh, Ed, I must have been in a fog. I forgot to. Here it is, May or June, and I forgot to make that first quarterly payment. What should I do? Should I make it now, or should I double up on the second payment for that? That is for the second quarter." And I always say, no, make it now, because you're going to be charged interest from the time that you made the payment from the time it was actually due. So if you double up the payment that you were supposed to make on April 15th, you double your June 15th payment, you're going to be charged interest for the period April 16th through June 15th for the amount that you were supposed to pay on April 15th. So make that payment, even if you're late, make it, because this way you'll stop the interest meter for late filing.
You don't have to absolutely panic, but listen to what Ed's saying, get it in there, you're going to be better off. Another thing, Ed, last year they gave folks a break from required minimum distributions. That is not the case for this year, correct?
Yeah, the RMDs, Dan, are back. And people think, oh, I don't have to worry about that. I'm not retired. Well, some people do, because the RMDs, the required minimum distributions, apply to people who are retired, who are over, basically at this point, who are over 70 and a half, who are retired, like, for example, federal retirees who have TSP accounts and they're over 70 as we speak right now. And the reason I say over 70 now is because the law was changed back in December 2019. The Secure Act raised the what's called the required beginning date, when you have to start taking your RMDs to age 72. Anybody born after June 30th, 1949 has a required beginning date of April 1st following the year that they turned 72. If you were born before July 1st, 1949, you have a required beginning date of April 1st following the year you turned 70 and a half. Well, anybody who was born before July 1st, 1949 is in fact over 70 and a half now. So they have to take their RMDs this year. And as I say, it not only applies to people who are retired, but if you inherited, let's say, an IRA from a relative, you have to take RMDs every year from that inherited IRA, especially if you inherited that IRA before January 1st, 2020. Because you decided to take that IRA and receive payments over your life expectancy. Yeah, last year you didn't have to take an RMD, but this year you do. You do. So the RMDs are back. And I just want to say one thing else. It's going to get more complicated next year in 2022 when the IRS updates its life expectancy tables.
Ooh.
And it's going to get a little more complicated, and I will be there writing a column probably later this year talking about the effect of the new life expectancy tables for those people who have to take RMDs.
Well, let me ask a loaded question here then, because I'm a geek for this stuff. I have read that COVID did actually impact actuarial life expectancy in the United States. Do you anticipate that that's going to be reflected in the RMD tables?
No, because the RMD tables were actually constructed last year in 2020 when all this was happening. The IRS decided not to implement them in 2021. They wanted to make some adjustments, but they're not about to update them again.
Got it.
So they're going to make them effective as of January 1st, 2022.
Okay.
2022.
And I know our history as a species has been pretty good. We tend to keep living longer. So is that something that you expect to see reflected in the RMD tables?
Absolutely, and that's why IRS did it, because people are living longer. They stretched out the life expectancies, which means that because the life expectancy factors are larger, that means that the RMDs for the same amount of money in the account will be smaller, so people can look forward to smaller RMD payments starting in 2022. It is a blessing.
Yeah, especially considering that, certainly COVID was a devastating blow to us as a people. Also hit a lot of areas of the economy, but kind of spared the stock market. People have some pretty nice balances in a lot of IRAs and 401ks and TSPs. Big balance, lower payout, not a bad thing.
It's interesting, Dan. You say that because of COVID, people died, and life expectancy tables, the life expectancy factors, because people were dying, and unfortunately, the life expectancy factors should reflect that and not go up, but they should go down. On the other hand, look what the stock market did last year.
Sure.
I just got my first quarter TSP statement. As you know, I'm retired from federal service, and I retired back in January 2006, and I've left my TSP alone. I haven't touched it, but I nearly fell off my chair when I saw what my TSP did during the year for the year ending March 31st, 2021. That is, from April 1st, 2020 through March 31st, 2021.
Yep.
My TSP got a return of 56%. 56%.
Yep.
I couldn't believe it. I could not believe it. Just by leaving it alone.
You're going to need to rebalance, Ed. No, I'm telling you that because CNS had a heck of a run. I woke up a little bit towards the end of the year, so guaranteed, whatever your mix was a year ago, you've got some rebalancing to do on that for sure. But yes, absolutely. All right, let's shift gears here and go to your latest FedZone article. And boy, I've just worked with you long enough that I know before I even ask this question that I just feel it depends coming on. But here we go. You asked the question in your article, should employees, meaning our feds, close to retirement, refinance their mortgage? So what's the answer, Ed?
Standard answer, Dan. I give you a definite, unqualified, no questions asked. It all depends.
I had a hunch.
That's my standard answer.
I had a hunch.
I cannot give a one set answer because it all depends on facts and circumstances.
Sure.
What's good for one person may not be good for another person. It all depends. I need to talk to the person, find out what their circumstances are, their personal finances, what they want to do, et cetera, before giving any type of answer.
Gotcha.
So
now
that's
you do share some thoughts within it. So for starters, your article identifies first, we're talking about feds within 5 to 10 years of retirement, but also feds who plan to stay in the house for 5 years. So give us your thoughts on that combo.
In general, Dan, in general, and it has nothing to do with the current situation of low interest rates, low mortgage interest rates, and high real estate values. This is a general statement that if one plans to refinance their mortgage, they should plan to stay on their house for a minimum of 3 to 5 years. And the reason I say that, Dan, is because when you refinance your mortgage, there's going to be closing costs. You're going to have some expenses associated with the refinancing, such as, I'll give you an example, state and county stamps. There has to be an appraisal. There's going to be other settlement fees associated with the closing, with your refinancing. That being said, if you're saving money by refinancing, you're going to a lower mortgage interest rate. You want to be able to recoup those expenses, and that usually takes about 3 to 5 years at least to recoup those expenses. And that's why I'm saying, if you're not going to stay in your house, you're not going to stay in your house more than 3 to 5 years. It doesn't really pay to refinance.
Gotcha.
Because you will not recuperate. You will not recoup the costs associated with refinancing.
Now, I'll tell you a little side story here because it about knocked me off my chair. My mortgage company sent me an unsolicited offer to reduce my interest rate. No cost, no fees, no nothing. I about fell out of my chair. So I'm kind of wondering if the marketplace has become sufficiently aggressive that our mortgage companies are saying, this guy's been doing pretty good by me and I'm making money off of him. I probably should do something to try and keep him. That's something that we're talking to our clients about. No guarantee your mortgage company will do it, but it's certainly worth the ask that if they are willing to do that without charging you anything, that is certainly a worthwhile exercise.
Well, Dan, I got to ask you a question about that.
Sure.
And that question is this. How many years are left on your current mortgage? How many years are left on it?
That would be about 20.
You got about 20 years. So you're still paying interest.
Yes.
Mostly interest on that. I assume it's a 30-year mortgage.
Absolutely.
Okay, and what does the mortgage company want to offer you in terms of a new mortgage, in terms of length of the mortgage?
It's the remaining balance that I have, and they lowered my interest rate substantially.
No, how many years?
Oh, the remaining 20.
They're going to give you a new 20-year mortgage?
Nope. I'm still in my same 30. I am just now paying a recalculated payment based on interest rates going forward. I've never seen anything like that.
So in other words, you're not getting a real new mortgage.
Nope.
In terms of potential length, you're going to stay in your current mortgage.
Yeah.
I see.
Yeah, they just dropped my interest rate. I am a little bit suspicious because it was right around the time that I was just about ready to pull the trigger with Quicken Loans. So I'm wondering if the Internet of Things, the way everything is interconnected, somehow they just got wind of it. But I'm just curious if any of our listeners, shoot me an email if you've encountered that with your own mortgage company, because I think it's a sign of the times. If they've got a performing mortgage, they've got a good client, they know, interest rates just cratered. They've crept up a little bit, but they're still pretty close to a generational low. I think they're starting to finally get savvy about, hey, let's hang on to this and let's do something easy.
Well, one question I'm going to ask you, Dan, and maybe the listeners who are in the market who want to refinance may want to think about is that if like you're in a 30-year mortgage right now, they're going to drop your interest rate. How about if they put you into a 15-year mortgage, since you have 20 years left on it, and maybe a comparable interest rate and take you down to 15 years?
That's not what they offered me. I saw the opportunity to get a substantially lower interest rate and not pay any fees or charges with it. And okay. I found that to be entirely too attractive. But I'm
just saying, maybe ask them just as a possibility, going down to a 15-year mortgage with a comparable interest rate even though you might have a little higher payment, you may end up paying less overall interest because you're into now 15 years.
Now, come on, Ed. I'm a money man here. You know me. If I'm going down to 15, they're going to lower the interest rate if they're going to get me to do that.
Okay. So it's worth asking. I'm sure the question is, you ask the question, it'll be free. You don't have to. You don't have to pay for them to answer the question. And this is what some of the anybody listening should think about, is that there are, let's say, in a 30-year mortgage, and they got, let's say, 25 years left on the mortgage, and they want to get a lower rate. Look into a 15-year, a 15 or a 20-year, even a 10-year, believe it or not. Interest rates are so low right now compared to what they were.
Absolutely.
You will save so much interest if you lower the amount of time that the term of your mortgage. You know, this may really in the end help you a lot. You know, end up saving interest expenses.
Yep.
So,
yep. Now
something to think about.
I'm going to display my geezer colors here because I'm old enough to have gotten mortgages back in the 90s. I remember double-digit interest on mortgages. So it's a very different time. So let's get back on track here.
Yes.
You identified a lot of planners advise paying the house off. We don't automatically agree with that. We feel it depends too. Paying the house off before you retire. You point out that might not be such a no-brainer right now. So tell us why.
I mean, paying it off.
Yep.
I mean, paying off the mortgage.
Yep.
Basically, if you feel you're saying if you're going to pay off the mortgage, pay off the mortgage.
Yep.
It's a good idea, in my opinion. It's a good idea to have as little debt as possible once you retire. And that includes mortgage debt. I know there's some financial planners. Oh no, you should have a mortgage for tax reasons. Well, under the current tax law, the Tax Cuts and Jobs Act of 2017, a lot of people are not itemizing anymore. They're taking the standard deduction. So if they're taking the standard deduction, they're not going to be deducting their mortgage interest. Mm-hmm. So not having a mortgage and not paying any mortgage interest, in fact, is not going to cause you to pay more in taxes.
Gotcha.
So we're going to put that reason aside for tax savings. But the other reason is, by not having that mortgage, it frees up more money for you for things you're going to need in retirement, such as travel, enjoying yourself. You know, this is a time that you should be not sweating out paying the bills, including a mortgage, but enjoying yourself. It frees up some money. Mm-hmm. So that may be a reason. One reason to pay off your mortgage. It'll free up that monthly mortgage payment.
Sure.
Okay. So that would be one positive reason for refinancing for paying off your mortgage before you retire.
Gotcha. And in your article, you also touch on the topic of cash out refinancing, and you've got some cautions to go along with that.
Got to be very careful about this. Under the Tax Cuts and Jobs Act of 2017, the rules regarding the deductibility of mortgage interest were changed with regard to cash out refinancing. And here's what the law says. When you do a cash out refinancing, Dan, we better define what that means.
Sure.
And the best way to define what it means is to get through an example. Suppose you have $100,000 currently left on your mortgage, mm-hmm. and your house is currently worth, let's say, $250,000.
Mm-hmm.
So most lenders will allow you usually to borrow up to 80% of the house value. So 80% of $250,000 is $200,000.
Gotcha.
So you could, in fact, refinance your mortgage and now have a $200,000 mortgage, meaning that the first $100,000 is going to take the place of your current mortgage, and now you have an extra $100,000 that you can use any way you want. because you essentially paid off with that old mortgage, this new mortgage, the $100,000 with the new mortgage, but you have an excess $100,000 that is available to you for you to use for anything. Now, the Tax Cuts and Jobs Act of 2017 says the following: unless you use that excess mortgage amount, in this case $100,000, to improve your home, make some capital improvements to your home, you cannot deduct the interest on that excess cash on that mortgage. If, for example, Dan, you took that $100,000 and paid off credit card debt, you took that excess cash and you paid off student loans, you used that money to take a vacation, you took that money, and I'm sure a lot of people in stockbrokers, financial planners like to get people's money. You took that money and used it to invest. You cannot deduct the interest on there.
Gotcha.
In fact, this is so serious, Dan, that I had several clients this year, my tax clients, who came in and they gave me their settlement sheets. They showed me they refinanced their mortgage during 2020. So they brought their financing and said, see, look at this. Look at my interest rate. Look how it dropped. And I took out more money because my house went up in value. I took out another $300,000 from my mortgage.
Oopsie. Because
the interest rates are so low. So now comes the question. The person gives me their Form 1098 showing the interest they paid during 2020. I said to the person, I have to ask you a question. It's mortgage interest. It's deductible. It's not necessarily. I need to find out from you how you spent that excess cash. What did you use the money for? What do you got to know it for? Because I have to make sure that that money was not used for something other than capital improvements to your home. And one person said to me, well, if I didn't, what is that going to mean? He says, then I cannot deduct the interest. So that one person said to me, in that case, I'm not going to tell you how I used it.
Whoopsie.
It's none of your business. It's none of your business. So I said to the person, maybe you're right. It's none of my business. Therefore, I'm not going to deduct it at all. Because unless you tell me the answer, I cannot legally deduct that interest. It's called the IRS's mortgage tracing rules.
Gotcha.
Mortgage tracing rules. And as a tax preparer, I have to find out what my clients are doing with their mortgage interest, or with their mortgage proceeds, what they're using it for, in order to be able to deduct the interest on their taxes.
Gotcha.
This is getting very interesting.
Indeed. And you kind of round things out in that article with reverse mortgages. Let's touch on that real quickly so we can kind of wrap up this episode and give the folks a good little nugget.
Reverse mortgages have been around for years, and here's the point. Instead of refinancing one's mortgage to a lower interest rate and cashing out and taking out maybe some more cash, more like we mentioned about the cash out refinancing, instead, if you're over age 62, purchase what's called a reverse mortgage, in which you're going to be paid by the reverse mortgage company for all the equity in your house, provided you live in there.
Yep.
Now, reverse mortgages are only available for homeowners who are over age 62. Over age 62.
Gotcha.
Okay. Again, you're being paid the equity of your house, but there are costs involved with reverse mortgages, and there's some hazards there because some people, if they end up taking out a huge reverse mortgage, and if some reason real estate values drop, which has happened, and the person and the homeowner moves out, wants to sell the house, they're going to have to pay back the amount of reverse mortgage that they're not getting from they sell their house, and whatever they get, the equity belongs to the reverse mortgage company, because they paid them. The reverse mortgage company paid the equity to the person while they're living there. Well, they sell the house, and there's not enough sale proceeds to meet the equity that was paid to the homeowner. The homeowner is on the hook.
Gotcha.
Reverse mortgage, there's been some horror stories about these things. I particularly am not a big fan of them.
Gotcha.
I am not a big fan of them, Dan. I prefer that individuals not use their house as sort of a bank here, and take money out of it. And they were, at one time, they were very popular, and there were some abuses with these reverse mortgages. The government has since, federal government has since cleaned it up, and I would only recommend if someone's going to get a reverse mortgage that they get an FHA, a federal government guaranteed reverse mortgage.
Agreed. Well, once again, Ed, on behalf of the feds, no one else is doing this stuff. No one's writing the stuff you write, so I'm very, very grateful what you do for the feds and what you do for us. And folks, that is a wrap. We are serving those who serve. Be sure to subscribe to this podcast on our YouTube channel and Spotify, and be sure to share it with your friends, neighbors, enemies, you name it. Check us out on Twitter and LinkedIn, and do not forget about our live webinars every week with Ed Zurndorfer and Jen Meyer. They are a dynamic duo. You can go check us out at the website, stwserve.com. You'll see the big red button. Click it, and the guru will come to you as we work to reach you where you are, teach you where you are, and serve you where you are. Sign up for one, sign up for all, share it with your friends. Be sure to read Ed every month in the Fed Zone, and also at blog.stwserve.com or fed-zone.com. So for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, good luck, Godspeed, and above all, it's your Fed life. Make it a great one, because you deserve it. Stay well, everybody. We are out.
Thank you for listening to the FedLife podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary. Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations. Neither Raymond James Financial Services nor any Raymond James financial advisor renders advice on tax issues. These matters should be discussed with the appropriate professional. Investing involves risk, and you may incur a profit or loss regardless of strategy selected, including diversification and asset allocation.